I always get a deer in the headlights look from bank employees. In this episode, I'm going to address the question, what is the velocity of money? Most bank employees don't understand this. Are you ready? So my name's Doug Andrew, and I've helped many people, especially in America, optimize their financial assets and conservatively, safely accumulate money for long-term goals like retirement. When they come to educational events, sometimes for 2 and 3 days, I will teach them about how money works. And when I ask people, so what is the velocity of money? Most people just sit there. Well, don't feel bad if you do not understand what I mean by that, because most bank employees have a deer in the headlight look when I ask them, so what is the velocity of money? Can you tell me? And they go, Now, this is sad in my opinion, but there's a reason for it. Now, let's talk about the velocity of money. I'm going to start simple, and then we're going to get a little bit more complex, and it will probably blow you away. Maybe you have thought about this but never connected the dots. I want to do that for you in this episode. So why is it that bank employees, they work at a financial institution, and sometimes they've been there 5, 10 years or longer. Sometimes I will ask even the branch manager this question, and they don't really know how to answer what is the velocity of money. And so sometimes as I talk to a bank employee, or maybe even the investment manager there at the bank, or the person that's over investments other than just putting money into the savings accounts or the CDs. So tell me a little bit about where you invest your money as a bank. And sometimes many of them don't even know. I go, well, there's probably 2 basic things that the bank does with the money that they receive from depositors, okay? So the bank more or less borrows money from us. Simply put, there are 4 things that you can do with money. You can spend it, you can lend it, you can own with it, or you could give it away. Now, most people think, well, owning with it is best. Well, yeah, I would agree, but not always. See, I actually own and loan on the same assets. But whenever you have money deposited in a bank, a credit union, or an insurance company, it's actually in a lended position. Are they just a benevolent institution paying you interest? Does your money just sit in some vault and magically they can pay you interest on that? No. Most people go, well, no, it doesn't sit in the vault. We have a little bit of cash on hand. So what are they doing with your money? They are investing it by either putting it out into investments or by loaning it back out again at a higher rate than they're paying you to borrow from you, okay? This is actually how money works. It's the parable of the talents, if you understand that parable, in the New Testament, Matthew 25. Because when you put money into an institution, like when he reprimanded the one who buried his talent, he said, you should have put my money at least in the bank with usury. Now, if your money's in a bank, somebody is paying interest and somebody's earning interest. Now, the bank is paying you interest, but where's the money coming from? It's because somebody else is borrowing money from the bank and paying the bank interest. Why? Because they're borrowing money at 4, 5, or 6%, maybe to help them in their business or to buy a home. And so they're hoping that the home and owning the home will be a greater rate of return than the net cost of the mortgage. That's why you do it. Or you're borrowing for business, or you're buying a widget machine for $50,000 and you're paying interest or borrowing money because the widget machine is going to make you an extra $100,000 or $200,000 a year. You're getting a return greater than the cost, the equipment cost, or the employment cost, just like if you would pay an employee $100,000, that makes you an extra $200,000 or $300,000. That is how money works. So here's what a bank can do. They can loan money out to people and charge 5, 6, 7%, or else they can invest it into actually safer places than even leaving the money in the bank. So why do they do either one of those, and why do they do one more than the other? It's because of the velocity of money. So get ready. So sometimes when I have gotten into a deep conversation with a loan officer or a bank employee, I will actually pose this question next if they don't understand how to answer what is the velocity of money. But before I share this with you, if this is intriguing you, be sure and click like and make a comment, share the video, subscribe to this channel because I'm passionate about education. I have over 500 educational videos on this channel. It's free. Subscribe, click the bell so you'll be notified whenever I post a new one, which I do almost on a daily basis. And stay with me to the end because I want to gift you a copy of my most recent best-selling book, which will take you to a higher level than what I'm even sharing in this episode, okay? What I'll usually say is, now, as a bank, you can loan out money to people that are borrowing to build a home or to use in their business or what have you. And those sometimes are not the safest because sometimes people fail in business, they file bankruptcy, or people lose their jobs and they cannot make that loan payment on their house. So why do you do that when you could just not loan money to people and you could turn around and put your money into insurance institutions, other financial institutions that are ranked actually on the average 6 notches higher in safety than most banks are. See, a lot of banks are rated maybe triple B by Standard & Poor's or whatever, and a lot of legal reserve insurance companies, which are not only the backbone of America, but the backbone of the world, they're rated AA and AAA. So many banks will take money you deposit into them and they pay you 1%. And they'll turn around and increase the safety by as much as 6 notches higher in safety, and they earn 5 times the rate of return, 500% more. They take the money and put it into an insurance company, and they earn 5%. How much more is 5% than 1%? Don't say 4. It's 5 times. They are paying $10,000 a year in interest on every million they borrow from us. They turn around, increase the liquidity and safety, putting it into insurance companies, and they earn $50,000 on every million that they only had to pay $10,000 for. That's a 500% return, and it's actually an infinite rate of return because they're earning 500%, and it's not even on their own money. It's on OPM, other people's money. So my question is this. If you can increase the safety, the liquidity, and the rate of return by 500% by not ever loaning money out to people, you can just bypass those and put it into insurance companies and make 500% tax-free, which insurance companies, you can accumulate the money tax-free. Why would you ever loan money to somebody who is building a home or trying to start a new business when they're not near as safe or secure as these big institutions like insurance companies? And they give me a deer in the headlight look again. It's because of the velocity of money. Are you ready to understand what that means? Folks, I'm about to share with you what makes the world go round. So here's what the velocity of money is. If a bank loans money to you and you're building a house, and let's say you're going to build $1 million house, and so you borrow $1 million, $500,000, it doesn't matter, you're taking out a mortgage. Now, they're willing to do that even though you're a higher risk, or you could file bankruptcy or lose your job or get disabled, compared to just safely putting it into an insurance company and earning 500%. Why are they doing that? It's because what are you going to do with that money? Whether you're borrowing $500,000 to build your house or $1 million, okay, let's just use $1 million. What are you going to do with that $1 million mortgage loan, that construction loan? You're going to pay the general contractor. And what's the general contractor going to do? Pay the subcontractors and the suppliers. So far, so good? What are all of them going to do with that money? They're going to loan it back to banks again at 1%. So people, they take the money they get when they go out and work or they sell goods and services, and they put it back into banks at 1%. The banks receive the money back again at 1%. They loan it back out again at 5%. They get it back again in a few weeks at 1%, loan it back out again at 5%. The average bank will churn the same dollars 17 times a year. That's the velocity of money. They're borrowing money, they're paying you 1%, and they're turning around and loaning it back at 5% 17 times a year on the same money. That's the velocity of money. Even in a recession, they may only churn it over 12 times a year, shucky darn. But folks, they can afford to take the risk because they're making 500% not once a year, but 12 to 17 times a year on the same money. That's the velocity of money. In other words, there might be so many printed dollars in America, but the actual money that flows in this country is 10 to 20 times or more than the actual money in print, because money flows. That's the velocity of money. And when you understand this, you can begin to become your own banker and take advantage of this safer and smarter than the banks do with less risk. Do you have a deer in the headlight look in your eyes right now? Folks, you need to understand this or you're missing the boat. So if you'd like to learn more about the velocity of money and how you can become your own banker, how you can use OPM if you want, you'll learn and read stories in this book I want to gift you of how I've been able to take my money and be able to churn it again and again, how I've been able to borrow my own money at 5% and earn 25% on my money while I'm using it for something else. This is the velocity of money. This is how money works. And my favorite vehicle for doing this is called the Laser Fund. And it passes liquidity, safety, and rate of return tests with flying colors. This is where banks and credit unions will take 30 to 40% of their tier 1 assets to invest for liquidity and safety. So if you want to understand the velocity of money, how to become your own banker, read this book, listen to it, watch videos. I will gift you a copy of this 300-page book. You just go to laserfund.com, L-A-S-E-R, fund.com. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, but I will pay for the book and I'll fire you out a copy. It's actually 2 books in one. This side is 200 pages, 14 chapters with all kinds of charts and graphs if you're a left brain thinker. If you're a right brain thinker, you flip it over and read this one, 100 pages, 12 chapters, 62 actual stories of how the Laser Fund will help you diversify and create the foundation for a successful tax-free retirement and future.